FreightWaves Today. I'm back in studio. Excited to be here with you. Julie, you did an amazing job. You guys, you and Malcolm, I think, did a great job hosting, keeping the fort alive, keeping the freight moving.
Thanks, it was a lot of fun.
Excellent job. We do have our celebrity guest picker / host, Max Fuller, my father. He is the founder of US Xpress. He'll be with us all show. He's going to be talking to our guest. We have a great lineup today. We have Drew Wilkerson, the CEO of RXO. Always, he is a Southern boy. He's a good old boy from the South. Is going to tell us all about what they're seeing at RXO. It's the third largest freight broker. Going to hear from them. As well as we have Tom Albrecht. Tom is we'll call it reformed Wall Street analyst. He was at BB&T. He's been in this industry for a long time. Now he's the Chief Revenue Officer of Reliance Partners. We have a great lineup today, and then we're going to end it with a conversation, Freight Expectations with Matt Leffler and I. We'll talk about it. Julie.
It's a great show.
Lots going on in the market.
There's a lot going on. I want to ask you about Forward Air. Their stock's up 14% today. You wrote a piece last night, I believe, yesterday?
Yeah, it was last night. I did it at the airport when I was getting delayed by all the storms in Chicago.
Basically stating that Amazon should buy Forward Air, right?
I think so.
So, yeah, talk to us a little bit more about that.
So, look, Forward Air's asset is this airport. The most important asset is this airport-to-airport business. The airport-to-airport business is a scheduled, think of it as an airline schedule, runs a very tight schedule. It's very different than the typical LTL business. It's expedited LTL. And they're selling essentially wholesale LTL services or to freight forwarders. The airlines are big customers of theirs. But this scheduled LTL business, I think, is the most interesting piece. And in the light of Amazon's announcement of moving into the LTL business, my thought is that one of the things that's come out is the fact that Amazon has a more limited real estate network. And ultimately, LTL is driven by how much real estate you own. That's the gap. And so Amazon's either going to have to build out a significant cross-dock network, or they could go buy it. And Forward Air's depressed stock price, I think, offers a really interesting opportunity. And I think Forward Air is unique in the sense not only can you get it available because it's out there, but also because their locations are next to airports. So it ties really well into the air cargo business, particularly the expedited air cargo business. Their major hub is in Columbus, Ohio, not too far from Cincinnati, and they use independent contractors entirely across their business. It feels like a perfect match for Forward Air. I mean, a perfect match for Amazon's new LTL business. And as Amazon is thinking about their network, they can either build it. They certainly have the capital to do it, but it's all real estate. Interesting enough is Amazon did not make a play towards the Yellow assets. I think Zach Strickland talked about that during the auction. But this is a great way for them to do it. And obviously, look, I didn't intend for the stock market to react to it. It's interesting to look at all the other transports are not rallying. Forward Air is. So Wall Street likes the idea. So management, if you're listening, opportunity. Amazon, if they're listening, is an opportunity. By the way, I'm really excited about this. The show has been out. We launched last Monday, and we're on track to do 2 million views of the show. Like we're getting about 250,000 people a day that tune into FreightWaves Today. Pretty remarkable. And you guys, I watched the show as an independent observer over the last 2 days because I was not in studio and I got to do it. I think it did a great job. It's quite entertaining. And I think we're quite proud of the work that you and Malcolm did when I was out. And so with that, let's get to the headlines. A lot is going on in freight.
We kick things off with a massive milestone for autonomous trucking that will fundamentally reshape the industry. Volvo Autonomous Solutions plans to remove safety drivers from its autonomous trucks and begin fully driverless operations on U.S. highways in the first quarter of 2027. The company aims to have more than 300 autonomous trucks operating by the end of 2027, with industrial scaling beginning in 2028. And revenue from the autonomous business is projected to approach approximately $3 billion within 5 years. Volvo currently operates commercially in Texas with safety drivers aboard, moving freight daily on routes between Dallas and Houston, Fort Worth and El Paso, and Dallas to Oklahoma City. According to Volvo Autonomous Solutions, the most important impact of driverless technology is doubling asset utilization, enabling trucks to operate around the clock unbound by human hours of service rules. Aurora Innovation, one of Volvo's technology partners, confirmed the driverless milestone in a LinkedIn post, stating that in the first quarter of 2027, they'll deploy those trucks with nobody behind the wheel in Texas. Over on the rails, agricultural retailers are raising serious alarm bells about the proposed Union Pacific Norfolk Southern mega merger. Darren Kopach, president and chief executive of the Agricultural Retailers Association, wrote in a published opinion column that his group has serious concerns about how this merger would affect members and the agribusiness sector as a whole. The ARA represents more than 5,000 retail locations supplying feed, seed, and equipment to farms and ranches nationwide. Kopach pointed out that the 4 U.S.-based Class 1 carriers already control 90% of rail freight traffic, and he said that concentrates their power to set railroad-friendly terms, driving up costs and threatening supply chain reliability for moving agricultural commodities, fertilizer, chemicals, and fuel. Freight rail rates have risen by more than 40% over the past 20 years, adjusted for inflation, about 70% faster than truck rates, Kopach wrote. 2/3 of the fertilizer for U.S. crops moves by rail, and Kopach warned that this proposed merger directly threatens the ability of ag retailers to operate and, by extension, impacts farmers and the food supply for all Americans. Finally, the Transportation Intermediaries Association is pushing federal regulators for desperately needed clarity in the wake of a landmark Supreme Court decision. The TIA is asking the Federal Motor Carrier Safety Administration for a federal rulemaking that would set standards on what constitutes a carrier that can safely be booked, leaving little doubt in its formal petition that the need stems from fallout from Montgomery versus Carib Transport, and the door it opened to brokers being found liable for crashes and other incidents involving a carrier hired by the third-party logistics provider. TIA President Chris Burrows cited the oft-quoted number that more than 90% of authorized motor carriers currently operate without an FMCSA safety rating, and he wrote on LinkedIn that in far too many cases, a carrier's safety deficiencies are only revealed after a catastrophic incident has already occurred. The core of the TIA request is that the FMCSA establish a federal motor carrier selection safety standard that informs brokers and shippers whether or not the use of a given motor carrier is reasonable, based on objective criteria determined by the FMCSA to correlate demonstrably with safety performance.
All right, so lots of good headlines. I wish we had a little bit more time to talk about them. We'll talk about the FMCSA and TIA with Drew a little later, I'm sure. But Max, I was so excited to hear that you were going to be here this morning when I got here. You're an equipment guy. You have always been leading technology in our industry when it comes to that. Tell us your thoughts on Volvo and the autonomous driver, fully driverless by 2027.
I think it's one of the most exciting things to happen in this industry in a long time. At US Xpress, we intended to be one of the first people to put autonomous trucks in the market. A lot of people haven't figured out how to apply them to the market, but we had a plan, and the plan would work very well. But autonomous trucks are coming relatively fast. You're probably going to see safety enhanced enhanced a lot along the way. And, the driver situation only gets tougher with demographics going the way it's going. So this is something that will help our economy quite a bit as we continue to move forward.
Dad, you're going to get a lot of hate on X from drivers who are out there that feel differently about autonomous trucks, that feel like their jobs are threatened. What would you say to those drivers that are concerned about autonomous trucks and effectively putting them out of work?
Well, it will change their job. It's kind of like AI is going to change a lot of people's jobs. There's still a need for truck drivers. The truck drivers do a lot of stuff other than hold the steering wheel of the truck. That's really what the autonomous technology's doing, is holding the steering wheel. They provide a lot of value for the customer. When they go into the customer, they sign freight bills. They do a lot of different things that the autonomous truck itself can't do. So I think drivers are going to still be an important part of the equation, but they're probably going to be more local, more regional, as opposed to being more long haul. The long haul stuff will be kind of like the rails.
What do we think the timeline is for point to point? I mean, Volvo says the ability to get to full, it's really a technology innovation thing, but to really have the practical point to point cross-continental autonomous, what is your thoughts on what does that take and what's the timeline for that?
Well, once the regulations basically get to the point they need to be, especially across the whole nation, then I really think that's going to be deployed relatively fast. probably going to be, when I say fast, it's probably going to be at least 10 years before we see a large, a large number of trucks operating across the nation. You'll have autonomous trucks running yards and stuff, which will be a little bit different, but really on highway, it's probably going to take 10 years for it to roll out.
So drivers will still have a job for at least 10 years. And of course, according to Max, they'll have job well into the future because they'll still need to be there. But we're many times, so don't send all your hate mail just yet. Wait for that. You can direct it to me. I get plenty of that. Well, Dad, appreciate you being here. Going to hang out with us, and we're going to talk to Drew Wilkerson, the CEO of RXO. Drew, you're speaking of stocks that are on the tear. You guys are absolutely ripping. What do you attribute that to?
Yeah, I think when you look at what's going on in the market right now, you're seeing tightness in capacity. And when you see tightness in capacity, that creates opportunities with customers. There's spot loads, there's projects, there are mini bids. And we've got a history for investors that they know during that time that customers lean on us to go out there and create solutions for them, to be the ones that as tender rejections rise, as you can see in your own data, in the SONAR data, that tender rejections continue to rise, that we are the carrier of choice to be able to create solutions for them off of that. And we've proven during those times that we take outsized positions in the market share.
Yeah, you talk about the fact that 10%, back in the fall when tender rejections are above 10%, is the time when spot opportunities really heat up for RXO and really the market overall. You guys have positioned yourself with this concept of capacity now being essentially, I've described it as the 911 operator when shippers get in trouble because their existing carriers are not honoring their commitments or are rethinking about what allocations they're getting. RXO has positioned itself to be that emergency response operator. How are you guys positioning internally to really handle those opportunities so that as the market continues to heat and tender rejections go up, that you're well positioned to do that so that customers are getting the kinds of capacity that they want?
Well, first, it starts with trust, right? Like customers have to trust who they're doing business with. It has to be somebody who's created solutions for them in the past, somebody who's delivered for them in the past. In times of stress, customers aren't going to go back to somebody that they don't know, that they aren't familiar with it. And so for us, our top customers have been with us for 16 years on average. They come back to us time and time again. The second thing is capacity. Having access to a lot of capacity, but it's vetted capacity. It's capacity that we know that hauls within our network on a daily basis, on a weekly basis. People who come back to us time and time again. And that is because of our relationships with the carriers. If you look at the way that we uniquely position ourselves with carriers to give them discounts on fuel, on roadside maintenance, on tires, on headsets that they wear, all of those things that a trucker and a shipper or a carrier uses in their daily life is something that we are a facilitator for. So we're the broker of choice for a lot of these carriers. And then the last thing I'd say is things have continued to change. Like if you look at drop trailer capacity, that used to be, whenever I started in the industry, something that was held closely by asset-based carriers only. If you go back a decade ago, we really started to build out a drop trailer network that now is one of the largest drop trailer networks out there in the brokerage network. And to be able to have capacity that is sitting on there and look and feel like an asset-based carrier to the shipper is something that's differentiated.
Yeah, Drew, I absolutely agree that that's a huge differentiator and something I always saw in my career, that shippers want an asset-like service and need the flexibility to be able to preload or have 72 or 48 hours to unload. So I agree with you there. But I've got to ask, we heard in the headlines that TIA is pushing FMCSA for more of a
clarity. I think the clarity is
on what actually is a safe driver. If there's no safety rating, how can carriers vet them as a safe, or how can brokers vet them as a safe carrier? So can we get your take on that?
The more clarity we have, the better. I think, for us, we've been vetting carriers for a long time in a differentiated way. With a lot of brokers, you can start a trucking company and go haul for them day one. That's not at RXO. You cannot do that. It has to be somebody that we know, that we can evaluate your safety rating off of, that we can evaluate what you've done on the insurance side. And then we've got a system that runs multiple times a day that checks to see what is your accident report? How are you performing within our own network so that we know who we're doing business with? But I think that the more clarity that can be provided out there, the better. And it raises the bar for the industry. It'll reduce theft. It'll reduce fraud. It'll increase safety. Like, all of these things are good for the industry.
Joe, you guys have, you post Montgomery, what we've seen in terms of how the market's reacting. How are shippers thinking about the potential for open up liability? How are they vetting companies like RXO and your competitors in the market to really get a sense for, are they doing the proper work and are they providing the kind of protection?
Right now, we're seeing shippers reduce the number of carriers that they're working with, and they're looking at people that they're looking at as an extension of themselves. Is this somebody that I trust to be able to haul freight? So I think, again, it goes back to what we were just talking about on the previous question. The bar is getting raised, and for us, that's a good thing. Customers value our service. They value the solutions that we create for them. They value the technology that we've had implemented and connected to their systems for years. And they value the relationships that we've built over a number of years.
Also, I mean, carriers, we saw the report that C.H. Robinson has started to trim and cull their carrier base. Have you guys been making the same decisions, Drew?
We haven't had to. I think when you look at how we vet carriers, look at how we grew up. We grew up hauling automotive freight that was just-in-time shipment, that was shutting a plant down. And if it shut the plant down, it was going to cost us millions of dollars. So our carrier vetting process has always been robust. We're hauling a lot of technology. We're hauling a lot of high cargo value goods. So, we're always looking to advance our processes and continue to raise the bar and continue to get better. But there wasn't drastic changes that we had to make to our network overall.
I mean, you guys were at one point owned by one of the largest asset-based trucking companies in XPO, which was the old Conway. Dad, I got to ask you, when I was at US Xpress, there was always this sort of anti-broker sentiment among the large asset carriers. Right. I've heard this. In fact, Heartland, one of the reasons that they've underperformed, according to sources, is that they still to this day refuse to haul any broker freight. How did you look at a company like RXO versus, say, your average broker, and how did you guys build relationships?
Well, actually, the average broker would probably stay away from for the most part. People like C.H. Robinson, RXO, the larger brokers we would do business with, but would usually try to do business with where they had consistent volumes, where they had pretty decent rates, where we had freight where we could continue to push good utilization on our trucks. This super cycle that we're in right now, it's got to be great for all the players in the industry.
Yeah,
pretty exciting.
I imagine sitting on the sidelines after going through the freight recession's a little frustrating for you.
It's killing me.
Watching this from afar. It's why this is like ESPN when we bring the former coaches onto the show to talk to our guests. Drew, as you think about larger asset carriers like a US Xpress or a Knight Swift or a Schneider, where they're very picky about who they do business with, I imagine that is an opportunity because the carriers are comfortable doing business. I mean, the legacy of RXO is that you guys were a part of XPO, Menlo Logistics. I remember when I was at US Xpress that Menlo was a big customer. And again, trying to figure out where Menlo ended up. Is that an RXO business? Did that end up at GXO?
That's managed trans. And so that's another beauty of large asset-based carriers. They're not just coming on to do business with our brokerage. They're also doing business with managed transportation, where we've got roughly $4 billion of freight under management. So it's access to all of the freight that we're offering out to large carriers. And you're right. I remember very early in my career at C.H. Robinson, US Xpress was a carrier that I worked with, and there was a lot of dedicated lanes that we had with them that were getting them back into key strategic customer locations. And then there was also the ones where you had something that fall off that US Xpress would typically have a truck for. It was at more than what you wanted to pay, but the service was always there.
Drew, I started that business, by the way, Express Direct. So
I'm sure you made some great money off of us.
The word rip came from the XD days of absolutely ripping. The problem was, and so I'm now confessing, as I've done on the show, I'm making up for all the sins of every game that's been played I kind of played those games in the day. So I'm now making it right by telling the world of the things that I did.
It's like your version of Usher's Confessions album, but you're doing it
That's
on this show.
exactly it. Or, the dude from Catch Me If You Can, who sort of goes on speeches about things that are. But one of the things, we had the rip of the day, and unfortunately we used to send this internally. It got to a customer as a really bad look. But Drew, I've got to ask, when you think about the importance of larger asset carriers, because there is an advantage where they have the network opportunities. They're not trying to necessarily maximize price when it's a backhaul opportunity. How do you guys sort of think about them as partners in your business?
It's the strategic fit that we can find on specific lanes. And then obviously with having the access to the capacity of you have people who have fallen off of loads is always something to be good to. But it's not just larger carriers for us. It's also private fleets. With the Coyote acquisition, we got access to private fleets, which we did not have previously at RXO. And that's differentiated capacity that always is looking for a backhaul to get back home, a backhaul to get back to their next customer load. And it's good, dedicated, strong capacity. And we've got a big team that does that moves 15, 20% of our freight doing that.
Drew, you mentioned SONAR tender rejections earlier. Thanks for the SONAR data reference. Capacity's tight. What do you think it's going to look like for the rest of the year?
Yeah, I think that there's nothing that's changing on the supply side that is going to loosen it. When you look at what's happening, supply is still coming out of the market. So that would tell you that it would continue to rise. We're watching closely what's happening on the demand side. Demand's still weak. If demand picks up in any way, I would expect tender rejections to go up significantly. If you think back during the COVID timeframe, you saw tender rejections approach over 30% at that point in time. So I think when you look at it, you're seeing this for the first time in my career, a supply-driven inflection that's sustained. And it's not something that is a blip in the market. It's not something that's caused by produce season. It's not something that's caused by weather. It's something that's continued out because of the regulations that have been implemented. And so that's a structural change in the industry that's not going away. So I don't see it loosening. And I think any signs of demand could tighten it even more significantly.
I mean, you talked about the fact that this is, and I would completely agree, is that this is the most profound change in the market since the transportation deregulation, perhaps, broker permission in 1985 of actually being able to just completely restructure the market. But do we think this is sustainable, Drew, for many years? Do you think, Max has mentioned a trucking supercycle. I've talked about it. Do we think we have the grounds for a trucking supercycle, or are you concerned that the bigger fleets will overcorrect like they usually do?
I can't predict what the bigger fleets will do. I would think that, the last 3 years would probably say like, hey, we're not going to invest in the same way that we did, because typically on an upcycle, it's not going to last as long. Like I think in the times of COVID, you had people who thought that was going to happen and that was going to happen forever. And that was the new norm. And it wasn't the case. So I can't predict what they're going to do as far as the investment side. But I think that any signs of demand, and you're talking about a mega super cycle that happens. And at that point, if capacity still comes out and continues to come out, which our meetings with the Department of Transportation have told us they still expect significant amounts of more capacity to come out of the market, that would be another tailwind to what happens in the market.
Yeah, I mean, you've got the federal FMCSA efforts, you've got the states are doing it, you've got the Delilah's Law. Dad, I got to ask you a question about just the capacity, because the temptation is always, when the market's tightening, fleets typically are adding capacity. Would you be doing that right now if you were at US Xpress? Would you be adding into this upcycle?
Looking at this cycle that we're going into, I'd try to add every truck I could because this looks like a long-term sustainable cycle that typically doesn't last that long. Usually the cycles are 3, maybe 4 years. If you look at what's going on right now, especially with the demographics of drivers are harder to get. That's where autonomous are going to help. But then getting more capacity, this is when you grow. You ebb and flow in this industry through the cycles, and you have to grow when the opportunity is there. And if you think that the cycle is going to last long enough, then you're going to really go for it. And this would be where I'd be hitting the accelerator pretty hard on driver recruiting, buying additional trucks, getting out and marketing to my customer base.
How do you avoid, or the industry avoid, overcorrecting? I think that's the big question.
Well, it's overcorrecting in one respect, but it's also, you got to look at the freight volume, because freight volume goes up and down also. If you look at the long-term cycle, right now the industrials are really moving pretty strong. Consumers still pretty soft. What usually happens after the industrials increase their capacity, then you see the consumer market come up. So this is going to be a long-term cycle. And I would probably be moving very aggressively into high growth at this point if I was a large carrier.
Yeah, Drew, how do you think about demand? I mean, you talked about demand being soft. Industrials do look much stronger, even in the rail data. What do you think it's going to take to get the consumer freight really moving?
Industrials have been strong, and even retail and e-commerce has picked up and performed better than other segments for us. Technology has performed well for us at RXO. But when you look at the housing market, it hasn't performed well, and there's no signs of life of what's going to happen on interest rates, which would drive it. And you all know well that for every new house that's built, it's 8 full truckloads. That's a lot of volume that's able to add. When you think about food and beverage, that industry has been down. And I think, when you look at the weight loss drugs that are out there, the ability to get fit, and then also people that are no longer in the U.S. because they're getting deported, like that's consumers that are leaving in food and beverage, that I think is a headwind to food and beverage for the foreseeable future.
I'm so glad you mentioned GLP-1s. It's my favorite topic. I am a proud member of the GLP-1 recipients or users. In fact, we had a great conversation on Monday with someone who runs a returns business that talked about just the fact that it's not just GLP-1s that are changing food consumption, but it's also consumers are far more sensitive about things like plastics, dyes, sort of the MAHA, and whether you're a diehard RFK advocate or believer, or just aware of things because of all the awareness. I think consumers are certainly changing taste. And I imagine that's a big, so we're going to hear about housing. We've got, by the way, Brad Jacobs on the show Monday. We're excited to have. I'll be sure to say it. I think you've met him before, Drew.
I learned a lot from him over the years.
But I am curious. The building's down, interest rates are high. Is there a case that building is going to come back, or do you think it's just really sort of down for the count until we see a change in interest rates and housing cost?
I don't think it's down for the count. I just don't know how long it's going to be down. I think that, and I learned from Brad that with everything there is an opportunity, and so I know him well enough to know that him and a lot of the other home building companies are using this as an opportunity to build stronger companies and be prepared for it. But I think that it'll come back, but the timing of when, I don't know.
Yeah, Warren Buffett bought a housing builder, by the way, which I think is, Warren Buffett's timing or Berkshire Hathaway's timing is obviously tells you something.
I'm going to switch gears a little bit, Drew. You guys recently won a FreightWaves Fraud Fighters Award. Can you walk us through what you guys are doing to prevent fraud?
Yeah, I think it starts with our process, and that's how we were built. I talked about that earlier. When you look at it, we were building a model on service. So we were very particular about who we would do business with. It wasn't about signing up as many carriers as you could. If you go back a couple of years ago, 2-3 years ago, there was a new article that came out every single week about we have X amount of carriers. And that was really just a vanity metric because it comes down to how many carriers you're using on a daily, weekly, and a monthly basis. And so for us, like you couldn't just come into RXO in the network. You couldn't book your first load digitally, which seems insane that somebody would let you book your first load with them digitally. But there are companies out there that do that. We wanted to know who you were, build a relationship with you before you started to come into the network and service the customers that we're working with. And so the model was built off of service. Now, whenever you start to look at process, we're always evaluating things. We're looking at on-time pick, on-time delivery. We're looking at communication through the life cycle of an order. We're looking at the tracking and tracing that they're doing. And then we built technology around that goes through and actually updates our system on all of these KPIs throughout the day in real time. So there are people that are monitoring what's going on with the carriers can say, hey, this person doesn't meet our qualifications. We're not going to use them. Or this is a great carrier. We're okay with actually paying them a little bit more because it's going to service our customers' freight better.
Yeah, I think it's such an interesting time, Julie, with the whole change. Not only is fraud a backdrop, one of the things I have picked up is there's just less public postings. I think RXO probably has relied less on the sort of public load board capacity. You've talked about your private fleet, how much of an advantage of access to private fleets. And I think one of the features that maybe isn't understood by those on the outside is that private fleets were never hiring the non-domiciled CDL drivers because
Right.
the risk of doing that is so much more exponential. So that's a capacity element that gives you guys an enormous advantage over some of your competitors, I imagine.
That's right. It's highly vetted drivers. You don't haul for these large Fortune 100, Fortune 500 companies without being vetted. So I think when you look at the vetting process, it's not just on the carriers down to the driver level at these companies. And that's a benefit for us whenever we know who it is. And it's a benefit for our customer that allows them to see the same people coming back time and time again that know their freight.
So Drew, what's your suggestion for shippers for how they can protect themselves in this environment?
Well, I think naturally they should just give all of their business to RXO, and I think that's the biggest protection that you can give. But I think when you look at it, it's knowing who you're doing business with, and understanding who they are, trusting the relationships, trusting the past experience of what people have done, trusting the data that they're coming in with, and they're not just talking to you. I think that's the biggest thing is trust the results that have been delivered for you in the past.
I imagine balance sheet is so much more important. The financials, being a public company, one of the few public brokers, I think one of two, that sort of, if you sort of take pure play freight, UNCH, has to give you a huge advantage because you can prove that in the event something catastrophic happens, you guys are, you're going to be around.
Yeah. If you get hit with an accident, if you get hit with a claim, can you pay it? Financial stability is in every one of our conversations with customers, especially large customers, because it's a protection of their freight that's out there.
Drew, I got to ask one last question before you go. We had Shelley Simpson on, the CEO of JB Hunt, last week. She was on. She took the job of JB Hunt right, I think, a month into the freight recession. You bought Coyote. We thought we were out of the freight recession. By the way, I rest in peace, freight recession. I'll never live that one down. So timing was obviously off. No one anticipated Liberation Day tariffs. How does it feel today to be running into a cycle? How much more rewarding is it for you as CEO of seeing the market respond to how well you guys are performing and how well you're positioned?
Well, I would say two things, right? Like one, if you think about when we did the spin in November of 2022. And so we were coming off of highs entering into the freight recession as we did that. And so navigating those times has made us a stronger company. It's made us a closer team. We have constant communication, and we've built stronger processes coming out of them. Now, on Coyote, we definitely thought that we bought Coyote at the bottom of the market, and it clearly took a leg lower. But that's made us better structurally. That's made us to where we have more scale, where we're lowering our cost to serve, where we have better, stronger capacity that is out there. And we have better talent. We've got better people. This is an asset-light business. It is all about the people. We've got the best people in the industry.
Drew, amazing conversation. Congratulations on what you guys are seeing in the market. Congratulations on the stock price. I love having him on. I described him as a good old boy. He's from South Carolina. But he worked in the trenches at C.H. Robinson, apparently used Express Direct on occasion when he needed to get built out. Now they're offering that service to customers, but probably a little bit more affordable than what we were doing. Drew, thanks for coming on. Appreciate it. And we'll have you back.
Thank you.
So Julie, I love Drew. He's got great energy. Amazing. We're going to be right back. After these messages, we're going to get with Tom Albrecht, the Chief Commercial Officer of Reliance Partners.
It's National Safety Month, which makes this a great time to ask how your fleet can prevent more accidents. Samsara AI detects risks in real time, giving teams more visibility into what's happening on the road and more context to coach drivers before risky moments become incidents. Fleets using Samsara Complete AI Safety Solution have reduced crash rates by nearly 75%. See the data behind the results in the Samsara Safety Report at samsara.com/freightwaves.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara Driving Coach,
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
All right, welcome back. So we're going to get to the SONAR update, but before that, Craig, I want to ask you about this SpaceX IPO. You and I are both big fans of Starlink.
Yes. I got to experience Starlink on United, and I had never experienced it before. Man, what a game changer. I watched the show, and it was so fun to watch the show, not being on it, and just seeing how, frankly, entertaining it was. And I'm not just saying that, I actually found that it was great to sort of watch it engage. You guys did an amazing job.
It makes car trips with my kids a lot easier, I'll tell you that.
What's that?
Starlink makes car trips with my kids a lot easier.
Yes, it does. We have it. We have an RV. We have an Experiment van. One of the things that so I was at this investor conference, investor summit in Aspen, Colorado. Small folks, small group, about maybe 50 people. And one of the things, one of the CEOs, the CEO of Trimble, actually had seen some of the shows, is a fan of FreightWaves Today, has watched some of this. We're going to have him on at some point. But one of the things that I was telling people about the show that's different is if you think about major media, you know, CNBC, Bloomberg do an amazing job, but they really focus on technology, AI, media, fashion, you know, sexier topics. We are the unsexy business network. No offense, Julie. We are the unsexy version of business news. So if you are concerned about the unsexy parts of the industry, freight, which I think is sexy, trains, the industrial manufacturing, all of that, this is the show for you. We are the version of business news when it's not as sexy. And what's great about that is we're able to feature guests in our industry, which are icons. You get people like Drew Wilkerson, Shelley Simpson, Aaron Graft. You get the, you know, if you go on CNBC or Bloomberg, you're going to see the folks that are in the physical goods economy once every other couple weeks, right? We're doing it every day, and I think that's what makes this really special.
It is. All right, with that, we are going to dive into the SONAR data with this quick update.
Capacity is still tight. We're right at 17% in tender rejections. Spot rates are near all-time highs. We haven't seen the July 4th rush. Things have not tightened significantly to give us that last push. We do expect it sometime next week. We had a viewer of FreightWaves Today ask for us to talk about market-specific conditions, make the data actionable for them. First of all, everything that I'm going to talk about and the data that I'm presenting is inside of SONAR. If you're a driver and owner-operator, the best way to get access to this data is the Blue to Blue app. It's on the Apple iStore. You can get it at the iOS store. You could also get our Chrome plugin. It's $25 a month. The Blue to Blue app is $10 a month, has all of the data. It's really in your pocket. The Chrome plugin, what we call Quick Rates, is $25 a month. But again, it's even if you have other rate products, it's always a good thing to get a second opinion. And both of those products are very easy. If you're looking for market data at a macro level, we have the Market Monitor, and it's $200 a month and really provides executive summaries of all the data that we're talking about. But I want to go through and really help those operators, and I'm going to do this going forward, is to provide some specific actionable guidance for those operators that are out in the market, which markets are doing well, which ones are loosening, which ones are tightening, where you should position your trucks, because it's ultimately about running in the most proficient lanes. And our Blue app specifically does that. It tells you which markets there's more outbound freight than there are trucks, and which lanes have more trucks than they have outbound freight. And ultimately, as a truck driver, you're trying to position yourselves most efficiently. So when we look at the map, we call it the head haul map or the haul map. It's all about which markets are tighter and which markets are looser. Looks at the flow of traffic. And this is much better than load to truck ratios because it doesn't get skewed by load board posting, ghost postings, duplicate postings, things like that. This is actual tender data looking at tender activity. And because there is a small charge to the companies for every load posted, they don't post a lot of garbage data or ghost data like you would see in load boards. It's a much cleaner data set, which I think is pretty important. But when you look at the map, what we're seeing in terms of better markets, the blue markets, so we call it Blue to Blue. If you're a owner operator, you want to run in the blue markets. You want to run where you can keep your truck loaded, because ultimately that's the most important thing you could do is drive utilization. And we look at the map in terms of blue markets. We look at the Rust Belt Midwest. You look at places like South Dakota, Nebraska, Western Iowa, Western Minnesota is really strong. Wisconsin looks good. You look at Eastern Illinois around Chicago, the Chicago metro area looks pretty strong. Southern Ohio, Nashville, Memphis, Northwest Arkansas, Dallas. Again, I'm looking for these blue areas. And look, scorching hot is around Dothan or Southern Alabama is actually doing really strong, as well as Southern California. So look at those deep blues. If you're a driver, that's where you want to position your trucks to, because that gives you the best shot. And then let's talk about areas to avoid. Florida, avoid it. Look at that around Orlando, that bright red is just a sign of how weak that market is. You're going to deadhead to Jacksonville to get a load. So avoid really anything that goes into Central Florida or Southern Florida unless you're getting paid a very high rate, but anticipate you're having to deadhead to Jacksonville or even back to Atlanta. And Atlanta looks okay. I mean, it is a positive market. It is a blue market, and that's what you want to do. Dallas, again, is quite strong. So there are some great markets here that you can keep your trucks running to. The markets that you should avoid: Fort Worth, Texas, Austin, Waco, San Antonio, anything in Central Texas along I-35 that's west, avoid that. It's not doing great. You're probably going to have to deadhead to Dallas to get a load out. Also, when we look towards the Northeast is kind of sloppy. It's not great. You're looking at places like New Jersey, soft. Massachusetts, pretty soft. And then the entire West, except for Southern California, again, avoid the red areas. These are areas where there are more trucks than there are loads. And so you don't want to position your truck there, because you're likely going to end up in a situation where you simply aren't able to find loads out.
All right, so great update, Craig. Parts I thought were interesting is the market is clearly changing, and it's changing quickly, and a second opinion on data is, in those instances, usually pretty needed. So there's been a lot of talk about DAT on X. You had a post lately. Let's talk a little bit about it.
Well, last night they sent out a note to their customers about the model basically was not keeping up. And they, what's interesting about this is They talked about Road Check Week surprising them and Memorial Day. And we've had this argument with DAT over the last couple of months, just about market sentiment. There was a belief that a lot of this was weather related. A lot of the tightness was weather related. There's been some confusing posts where just about flatbed conditions and things. But one of the things I think is apparent, and we saw this when the freight market was really soft, DAT's data was very hard to compete against, frankly. It was very hard because customers were saying, hey, I've got the data, I've got the load board, I've got the data. I don't know that I see the value in an additional data product. And it was hard to sort of differentiate itself because there was such a big spread between what the market was clearing out and what you could get for it, because accuracy wasn't important. If you had loads, you could set the price. What we've seen, and look, I would say this is there is a lag. We built high frequency data. The idea of high frequency is that it refreshes literally within 24 hours. Everybody's on the same set of conditions. Plus, a lot of our market intelligence is based not on spot rates, but actually tender intelligence and tender data, which are actual loads. It's not ghost loads that are posted on a load board. We don't draw any conclusions from load board data whatsoever. And I think that gives us an advantage to sort of understand the market. You know, Drew Wilkerson talked about the importance of tender rejections in understanding market sentiment. Tender rejections lead spot rates. That's what this is all about. And my real statement here or thought is that when you are talking about a market that's heating up and a market that's changing so quickly and things are tightening, you need high frequency data. And we're seeing it really happen. We've had the highest number of logos in our history over the last 2 months. And a lot of that is because of the need for high frequency data. And you've talked about it. A second opinion is also important. Regardless of whether you're using DAT's data or some other data model, getting a second opinion, it doesn't cost that much, particularly with the blue to blue product, particularly with quick rates. You might as well have that as a sort of a spot check. It will pay for itself in simply 1 month. Even if you're an owner operator, it's priced at a level. And again, in a market that's tightening, in a tightening market, it's important that you have high frequency data that will pick up those sort of changes that are quickly. And that's one of the reasons that we have been so on the tightening since November and talking about the conditions and talking about what's likely to happen. We were not surprised by the Road Check Week and the impact of it, nor were we surprised by the impact of Memorial Day. We're not going to be surprised by July 4th. It's going to be super hot.
Yeah, and if you're a broker in this market and you are trying to make a margin as capacity is getting tighter, knowing when the market is going to change and being on the precipice of that instead of reacting after the fact is absolutely where margin is made and is necessary.
Yeah, I mean, look, like I said, one load, get a second opinion. One load pays for the entire month. If you're a driver, just position yourself. Again, a second opinion. And look, I'm not saying that DAT's data is not quality. Like, I would use it as well as a second opinion. And look, there's going to be times where it's going to pick up things in the market that our data doesn't. There's going to be times when we pick it up. It's good to have a second opinion. We like to focus on high frequency data. I think it's a really important element when you have a market that is tightening as fast as it is and is expected to tighten. That's where SONAR is built for these types of markets. You know, we have something coming up next week, the DASH, which is the driver app shortage. Added app, not driver shortage. Driver app shortage hackathon. If you are interested in vibe coding, again, it is so easy. You could use Replit, you could use Claude Code. Coding has never been easier, but if you have an application that can make drivers' lives easier, it could be fleets, operators, it could be employee drivers. If you believe that you can develop something, this is your chance. We've got a panel of venture capitalists that are going to determine who the winner is going to be from Autotech Ventures. And we're providing an SDK, we're providing our API at SONAR that you can use to hack and build. Go build something that makes drivers' life easier. There's no cost to do this. Just takes a little bit of time, and with these applications, it's absolutely amazing.
That's right. So the kickoff meeting for that is Monday. We've had over 30 people sign up so far. And if you do want to sign up for that, you can do that either on the FreightWaves website or the SONAR website. There are links to both there. We are going to hear from our sponsors and take a quick break and be right back with Tom Albright.
Do you ever see yourself short on trailers right when demand picks up? Our friends at Premier Trailer Leasing can help you stay ready. With more than 70,000 trailers and over 40,000, again, trailers with 40 locations nationwide, Premier gives businesses flexible access to dry vans, reefers, flatbeds, and chassis when plans change. They're known for transparent pricing, quality equipment, and 24/7 in-house road care support. So you can get more than just trailers. You can get a partner that helps with your operation and keeping it moving. Visit them right now at premiertrailerleasing.com to get set up before your next big search.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
The map is changing. As global uncertainties rise, the future of the supply chain is moving closer to home. Welcome to the new coast-to-coast North American network. Driven by massive reshoring trends and next-gen industrial innovation, optimized by AI workflows that build unshakable operational resilience, and locked down by proactive security against evolving freight fraud. Are you ready to navigate the shift? Join the industry's top minds to build the future. The FreightWaves Domestic Supply Chain Summit, streaming live June 17th. Register for free at live.freightwaves.com.
Welcome back to FreightWaves Today. Man, we have a guest today. It's an amazing show. We had Drew Wilkerson. So excited to have Drew. He is such a great guy. What is happening to our table here? Our desk is blinking all of a sudden. I don't know, Tom, if that means something. It's like a warning of how just, like, look at this.
It's going to be the hottest tapes
of the day. It's a brand new desk. The desk is excited that you're here. It is excited about freight. That's what it is. Can we figure out, production, what is going on with my blinking table here? Amazing. Well, Tom, you're an institution. You have been around. You were a sell-side analyst for BB&T on Wall Street. So you've been around this industry for many, many years. What exactly, you now are at the largest insurance broker connected to trucking. You're the chief revenue officer of that business. So many things are happening in this market.
It's really exciting. It's the most exciting time we've had in years, frankly. It was exciting to call the downturn, although none of us expected it to be that rough. But it's really exciting for our customers to start experiencing prosperity again. And I heard you talk about the supercycle earlier. I've got a few thoughts on that when it's appropriate, but it's good. It's, what's the Frank Sinatra song? I'll come back to that later. I can't remember it, but it's very appropriate for right now.
Yeah, it is. It feels like a completely different market. Now, as someone who worked on Wall Street, you worked closely and maybe at times competed with Donald Broughton. Donald Broughton passed this week. He was an advisor. It's interesting. We had John Larkin. I think you guys called it the Three Amigos. It was Larkin, Broughton, and Tom. Where the first three advisors we had at FreightWaves, by the way, we're 10 years into FreightWaves, which I think is pretty remarkable.
It's remarkable. Congratulations on that, as well as this new show.
So any thoughts on Donald Broughton?
Well, he's going to be deeply missed. The audience may not know, but I hired Donald back in 1996 when I was at A.G. Edwards, which now Donald was already in the research department. He was working for a beverage analyst who had hidden an illness, and one weekend that analyst died.
Oh, man.
And simultaneous, my junior analyst was going back to graduate school in just a few days. And so Donald and I sat down. We were doing lunch periodically anyway, so we had a friendly relationship, but learned a little bit more about his background in distribution at Dr. Pepper, and felt like he'd be a good fit for my team, and so hired him. Now, I ended up leaving about a year and a half later to go to Chicago, but really enjoyed working with Donald. Sometimes he could get under everyone's skin just a little bit, but I think he meant well. He was a provocateur in the truest sense of the word. He loved a non-consensus view, and I think the industry really misses him already. I've heard from so many people. Not realizing that Donald and I had connections going back 30 plus years ago.
Yeah, really an institution, somebody that was well known, was a frequent speaker. You know, he got to see freight flows, which was his favorite metric. Freight flows really peak. It's fortunate because everyone who's been around this industry has enjoyed seeing the market come back.
Absolutely.
And certainly a sad situation. It's our thoughts, as we said it on the show, go out to his family. Tom, you have a unique position. I mean, you know, probably most, I don't know if more infamously involved in Celadon at the sort of 2019 freight recession, the tail end of that. You've also at Reliance, you're seeing a lot of new entrants come in. You're seeing a lot of exits, just being an insurance carrier. You guys have really the trends. What are your thoughts on where we're at today versus where we've been in the last sort of 2019 cycle and sort of coming out in 20?
Yeah, so first of all, just for the audience to understand, so, you know, we work with about 10,000 customers, over 9,000 of them are trucking companies and about 700 freight brokers. 90% or so of our customers have under 100 trucks. And have we seen a surge in new entrants? Maybe a little bit year to date, but I wouldn't say in any great measure. I think there's still a lot of damage that's been done out there. There's been a lot of new DOT numbers registered this year. Part of my theory, Craig, is that the fraudsters are stockpiling the DOT numbers. I think they're anticipating that it's going to become more expensive and more difficult to get a DOT number down the road because there's going to be additional changes coming from the FMCSA. So I think some of the increase in newly registered DOT numbers reflects the fraudsters trying to get ahead.
They're just basically putting them on the shelf so they need them
Absolutely.
When to burn. I have argued, and of course this is very controversial, that the DOT should basically cut off new registrations to create a market value, because the problem is these things have no value. We had the TCA president on earlier this week where he talked about the fact that you get a satisfactory rating the day you start with, you pay you $300 and you're immediately a satisfactory rated carrier, which means that the incentives are there if you get an unsatisfactory rating to just burn that one and go on to the next one. And it means that if there's an infinite number of registrations available, then there is no value put on it. And I've used the this is really going to upset people, the tokens in the taxi industry. One of the value propositions is that token becomes pretty valuable. And if you want to make the carriers care about their reputation and care about their rating, limit the number of ones that can be produced. And of course, that is antithesis. I've gotten a lot of hate mail on that one. Tom, how do you clean up from an insurance perspective, how do you think we should clean up this industry in terms of really ensuring that we have properly vetted the operators?
Well, so first of all, I heard your interview with Drew, and that was very insightful. We've also had an opportunity to meet with the DOT and the FMCSA, and we've offered a number of suggestions. So before we even get to the topic of insurance, if we want this industry to be better, then and have more underwriters eventually come to the industry, you've got to fix all of these points that have driven underwriters crazy and made the roads less safe. So, for example, I think a lot of things are out there as a possibility. I can't say for sure what's going to be enacted, but I wouldn't be surprised if we see a minimum number of hours to get a CDL. Right now, there's no minimum. Now, reputable CDL schools, they'll state up front, it's 160 hours of training or maybe 240 hours. There is no actual federal standard. So I think we could see something along that. It may be a mix of hours and demonstration of core competencies. I think we could potentially see an increase in the insurance minimum. I think we could potentially see an increase in the freight broker bonding. And we could go through probably 8 or 10 other things. I think we'll see some enhancements, for example, around ELP, the English language proficiency. Right now, it's only an out of service violation. There's camera footage of drivers who are written up, and the next day they're driving again. So maybe that CDL will be suspended in the future. Maybe the equipment will be impounded. There's a lot of things that are being discussed in the industry here.
And the states have done that. I think Oklahoma passed a law that if you are in violation of certain rules, I believe it was English proficiency, then they can seize your equipment. I don't know if that's been, I haven't seen reports of that actually happening.
Right.
But they do have the right to do that. Now the question is the enforcement. You mentioned something that, look, the entry-level driver training program was completely off the radar. It was something that the ATA had wanted for many years. The original rule was released, I think, in 2017.
Yep.
It finally went into commission in 2022. But it was the idea that a fleet could train its own drivers, and as long as it was in the registry database, it could effectively do it. One of the things that was originally proposed that did not make it into the final rule was the minimum amount of hours that a driver has. I'm a pilot. I fly airplanes, and I can tell you the most important thing that goes into being a pilot is proficiency. It feels like that was a big miss. Even the ATA's sort of argument that was somehow a win feels really misaligned with reality.
It was a total mistake. And then to compound it was the whole self-certification for CDL school, CDL instructors. Max, I've known you a long time. As I recall, you're not really a golfer, but self-certification would be like you saying, I'm self-certifying that you're a scratch golfer, and I know better. And that's kind of the process we went through.
He's not a very good golfer, neither am I.
And that's kind of what we went through. If we go back to 2019, there were 6,000 TPRs or training providers in their registry certified around CDL schools. By November 30th of last year, the day before they began to make changes, it was 39,554. So it exploded more than sixfold. It's crazy. And a lot of those were fraudsters. They were handing out CDLs like candy at Christmas time. And it led to the roads being more unsafe. And I tell you what really gets me excited, when I talk about additional teeth, so for example, there was the decision that we're going to be moving away from self-certified ELDs. But really, the teeth hasn't been put into that yet. There's a process. Yes, they're removing 10 to 12 ELDs every month that it's clear that they're cooking the books from somewhere overseas, or cooking the device, I should say. But we don't need 1,000 ELDs. We're probably on the way to 50 or fewer. But next year or late this year, we're going to see an announcement on who the approved third-party companies are that validate the ELDs. When I met with the FMCSA a little while back, I forget the exact number, but I think he said that there have been over 400 applications for ELDs in recent months. Not a single one of them had been approved. Well, listen, that's just the fraudsters just trying to get their devices registered.
Yeah, it's interesting because the self-certification, the incentives are so misaligned, and the fact is you don't have to be an American company. And we've seen stories, we've reported on it, but there's been conversations about the fact that some of these fleets, some of the fraudulent fleets, Super Ego was featured. It identifies as a trucking company when it wants to, C.H. Robinson's Carrier of the Year, and then it doesn't identify as a company when it doesn't want to, when 60 Minutes is pounding down the door. But they are also, reports are that they had some investment or had launched or was supporting an ELD device company, which has been known to, the conversation of self-certification, being able to edit those devices is a big problem.
Well, and I would go beyond that, and I can't speak too much to that. Super Ego was never a customer of Reliance, but we've all heard the stories. But I think what folks, especially the compliant folks, have started to realize over the last 6 to 9 months is how brazen the cheating has been. It's not like they put down on their insurance that they've got 12 trucks when they've got 14 or 15. They'll put down 2 and they have 500. We know of an instance last year, I believe it was in May, there was a trucking company that was hit. The company that hit them listed 1 truck on the COI, but they had 1,000 trucks. And 600 of them of the drivers didn't even have CDLs. So the level of cheating, the level of unsafe practices that have been allowed is just absolutely astounding. And Craig, if we go back just 3 or 4 months ago, the narrative was you can't have a supply-driven recovery. Well, first of all, that's silly. That's what's underway right now. Why can't you? Because we had an abuse of supply that is the single biggest reason why the freight recession lasted 4 years instead of, let's say, 2.5 years.
Yeah, it's interesting. Zach Strickland wrote an article a couple years ago with the fact that we had 25% more capacity.
Yep.
I
remember
caught a lot of heat over that because people are like, this is impossible. There's no way that amount of capacity. It's very clear. It was, one of the interesting things about the freight recession was that no one really understood what was driving it.
Yep.
And I think all of us, myself included, kept trying to sort of explain these alternative realities. It was Triple P funding, that it was SBA. All of that has something to do with it, the proliferation of brokers. But ultimately, this immigration story is part of it, as well as the lack of regulation. I don't know that anyone really wanted to admit that.
No.
Or was even aware of it. And I talked to a lot of folks. In fact, Dad, I asked you, you were the chairman of US Xpress, really when the freight recession started in 22 and 23. I asked you about non-domiciled CDLs. It wasn't really on your radar back in those days. I don't think any of the big executives even realized how.
If you really look at what happened was, with COVID and the high rates that came along with COVID brought a lot of people into the industry that didn't know anything about trucking. I also brought a lot of people from outside the country into trucking. And that ended up being a real problem. That's where all that capacity came from. And then the brokers all grew with that type of capacity relatively fast. And that just compounded the problem.
How frustrating was it for you seeing this market really, small operators who were non-compliant really grow substantially while the largest players were not making a profit and couldn't, were struggling?
Well, being in the industry for 55 years, I went through a lot of different cycles. And I can tell you, there's different elements that created, problems in those cycles. The cycle that we saw after COVID, to me, was probably one of the worst, and we saw the worst downturn during that period of time. Part of it was capacity, part of it was nobody's playing by the rules, and it's highly frustrating for carriers trying to do things right, and that was a real problem. I guess that's one of the reasons I left the industry.
Yeah, I mean, you sold your business to Knight-Swift. Tom, supercycle, a term that we have talked about. Drew talked about it. I talked about it. I've heard you talk about the supercycle. Are we going to have a trucking supercycle?
It sure feels like it. And I want to give your listeners kind of a sense of a contrast. So if we go back to the 3 cycles before COVID, because COVID was one of its kind, freight was on steroids, demand was going crazy. But in the 3 cycles, which was roughly 04, 05, then late 13, 14, and then second half of 17 and 18, each of those had one regulatory change. And I'm thinking about Billy Crystal and City Slickers, the one thing. Well, and yet those were pretty special periods for 18 to 24 months. You could argue the 04, 05 one was closer to 3 years. But here we've already had 5 things, some of which will continue to be tweaked, but we've had ELP, non-domiciled. We've had the Montgomery case, ELDs, and CDLs. And we've got, 6 to 8 more things that are coming down. So if one regulatory change could lead to a pretty good period for 1.5 to 2 years, and we're looking at potentially cumulatively a dozen, yes, this has the makings of a super cycle. I don't want to go on the record yet whether that's 4 years, 5 years, 3 years. Let's handle it 1 year at a time. But it's unlike anything any of us have ever seen in our career, the amount of change that's coming down the pipeline.
Tom, I remember when you came on as an advisor 10 years ago, you had made the statement that truckload was in a cyclical decline or a secular decline. Is that still the case? Do you still believe as a commodity, as a business, that the volumes are in secular decline and this is just a reset of the market? Or are we seeing with reindustrialization, factories starting to heat up, AI data centers, defense spending, energy, so forth, do we think that changes? Are we going to see another run in volume?
So far, we haven't seen that yet outside of the industrial sector. And even that's kind of a hit or miss. It's so driven by AI, data centers, and energy. And I heard you guys talk earlier how basically housing's flat. Automotive's flat, although at a pretty healthy level. 16 million cars a year are being sold. I think there's the possibility that we could break away from this secular deterioration and actually get back to it, seeing truckload volumes grow at least at the rate of GDP, if not nominal GDP, which would be even more exciting.
Well, the railroads are certainly feeling some heat.
They are.
The railroads, it's funny, I post charts about railroad volumes up 2-3%, and I get a lot of heat, like 2-3%. That's a railroad, that's GDP. The fact that railroads are growing volume, we saw from the AAR report, the American Association of Railroads, that comes out every Wednesday. We cover that every Wednesday. Tune in for that segment as that report comes out. But what it tells us is that the industrial economy is growing. Rail volumes are growing despite coal, which is in a long-term decline.
That's because truly secular decay.
It is not coming back, regardless of the efforts. 2 questions I want to ask before we go.
Sure.
One is thoughts on Montgomery brokerage insurance. What are you guys seeing? What are you hearing in terms of the impact for freight brokers in a post-Montgomery world?
Well, so that's nearly 4 weeks ago. Every week it's been different. Obviously, it's going to be highly inflationary. I led a panel called Life After Montgomery at our Laredo event this week, and one of the insurance participants talked about how some of the large brokers who carry a lot more insurance than maybe the general trucking community realize, that a lot of times $10 million to $30 million of freight broker auto liability they've been carrying. They are right now exploring whether they want to cut that back a little bit just to limit their exposure. But I think over the long term, those folks are going to be winners. It's going to be all about documentation and protocols as we go forward, having the right SOPs, and I'm sure our plaintiff attorney friends will be happy to help bring about some clarity around what's black and white. And I say that with tongue in cheek, but that's ultimately what's going to happen. But the best, most compliant carriers, they don't have to worry about that much at all. Yes, they'll get sued, but if they've got good processes, I think Kavanaugh was very clear.
Speaking of lawyers, we're going to have Matt Leffler on for Freight Expectations. He's going to tell us his thoughts. He's the only lawyer I like, so that's good to have Matt tell us what he thinks. Tom, before you go, I wrote a piece that Amazon announced an LTL business. There's been some conversation, and initially the LTL providers sold off. They've since recovered. But I wrote a piece last night that Forward Air, that Amazon should buy Forward Air to fill out their expedite LTL network. And I know you know the Forward Air team, having been an analyst that followed it. What are your thoughts on that as a thesis?
I had not read your piece, but I think that that's certainly something they should consider. And obviously, given what's happened at Forward Air and their stock and the massive disappointment, I think that would be a really nice outcome for the Forward Air shareholders. I do want to say one thing, and I'm not going to comment specifically on Amazon's drivers, but I think there's been a sense that the industry's always commenting on that the DSP drivers, they're not viewed as highly as some of the larger asset-based fleets. So I think Amazon's going to have to figure out what the new world of compliance looks like as well post-Montgomery. I've not heard enough narratives around that. So if they want to build an LTL company or continue to build truckload, they're going to also need to deal with some of the same issues that others are worried about.
Well, I think they are. I mean, I know they're making significant investments. And look, the Amazon drivers that have gone through training program are actually some of the higher quality safety drivers. There's a lot of noise out there. Amazon's just so massive.
Correct.
And just the numbers and the sample size, and it's such a lightning rod for people.
Yes.
And I think it gets a lot. It doesn't get the credit it deserves, in my opinion, because they do. If you look at the data in terms of accident frequency, it's actually not that high on the list. There's a lot of other large asset carriers. Western Express is very high up that list in terms of accidents and fatalities per truck and incidents. And so you see Amazon's actually much lower on that list, which I think is a testament to the training that they give their drivers. Like I said, naturally, just the scale of that business is so substantial, you're going to have more incidents.
Absolutely.
Well, Tom, really appreciate it. We got to have you back. I mean, you're a wealth of knowledge. You've got all this great institutional experience. Dad, your closing thoughts on trucking supercycle. You've said we're going to have one. I got to ask, how long do you think, Tom is willing to say we have a year. Do you think this is a multi-year cycle?
Minimum.
Minimum of a year.
Yeah, if you look at the down cycle being 3 to 4 years, you probably look at the up cycle probably actually being longer than that. The one thing that the ATA, and this is a number that came out probably 10, 15 years ago, when manufacturers in our country, there's 4 to 5 movements.
Yes.
Where if you have imported products, it's normally about 2 movements. So that's actually going to increase the need for more capacity in the industry. And that's the reason I say this thing's going to be a lot longer than what most people think.
America, reindustrialization at its finest. We are seeing that in the freight flows. We're seeing that the coasts are no longer driving the freight market. It's happening in the Midwest. It is a beautiful thing to see. It could be, as AI data centers a part of that, we have a sit rep inside of SONAR. You can get it where we actually explore the impact of AI data centers. It's the fit spinning, it's energy, and it's industrial competitiveness. And it's interesting to see how the industrials combined with compliance is really changing it. Coming up next, it is Freight Expectations with our favorite lawyer to talk about Montgomery and everything else. Stay right here.
Race car drivers like NASCAR champion Jesse Love are a lot like commercial drivers, pros. But even the best in the world still watch the tape to see what they missed and get better next time. So we created the Samsara driving coach.
Great race, Jesse, but you were following too closely and you were speeding.
Okay, you got me on that one.
Samsara uses insights from millions of professional drivers to coach drivers in real time.
Because even champions need a coach.
Give me the keys.
What's the masterclass all about? Well, here's what I'm going to tell you. If you're a driver, you're an owner-operator, you're a fleet owner, whether you're in compliance services, dispatcher, no matter what it is, masterclass is for you. Every 2 weeks, you're going to sit down with me and we're going to go over certain business topics that are related specifically to your small trucking company operations. We're going to help you with everything from compliance to how to negotiate better on the spot board, how to find direct freight, and everything in between. This is the reason why you don't want to miss out on Masterclass. It's about an hour to an hour and a half, and then on top of that, you'll have the library to you so that way you can always research and reflect back onto it. Don't miss out this opportunity. This is built specifically for you. I'm excited and I hope to see you in class.
Imagine a world where your freight moves as fast as a digital pulse. What if your visibility didn't just tell you where a truck was, but exactly where it needed to be 48 hours from now? Think of a logistics network that corrects its own mistakes before they cost you a single dime. What if your supply chain could think for itself? Imagine AI agents negotiating rates in milliseconds, predictive models that solve labor shortages before they even happen. This isn't science fiction, it's the agenda. On July 15th at the historic Old Post Office in Chicago, FreightWaves presents the Supply Chain AI Symposium. We are defining in real time how AI is embedded into every mile, every warehouse, and every handshake. Because in 2026, the future isn't just coming, it's already negotiating. The FreightWaves Supply Chain AI Symposium. Secure your spot now.
The map is changing. As global uncertainties rise, the future of the supply chain is moving closer to home. Welcome to the new coast-to-coast North American network. Driven by massive reshoring trends and next-gen industrial innovation, optimized by AI workflows that build unshakable operational resilience, and locked down by proactive security against evolving freight fraud. Are you ready to navigate the shift? Join the industry's top minds to build the future. The FreightWaves Domestic Supply Chain Summit. Streaming live June 17th. Register for free at live.freightwaves.com.
Welcome back to FreightWaves Today. I am your host, Craig Fuller here. Tom Albrecht, I asked him to stay in the studio. It was such a great interview. And we're going to talk to our favorite lawyer, Matt Leffler. It's free. This is the best benefit we give to our viewers and listeners. Free hours with an attorney. Again, as Matt likes to say, if you need legal advice from someone on TV, you definitely should get a real lawyer. Matt,
100%. Great to see you guys.
Not that you're not a real lawyer, you're just not someone else's real lawyer.
I'm happy to represent anybody if they can pay the retainer.
That's true. I understand you're very expensive, so that's
reasonably priced. We're reasonably priced.
Fair enough. Well, Tom is in the studio. We just had Tom come over. We've had a real packed show today, Matt, and that's one of the reasons that the schedule has ran over, is just because we had Drew Wilkerson, the CEO of RXO on. We've talked about, I wrote a piece, and I want to get your take on this, that Amazon should buy Forward Air. The news earlier this week is that Amazon is rolling out LTL. There's conversation, some of the analysts, initially the LTL stocks sold off, which they always do whenever Amazon announces anything. I remember when freight.amazon.com came out, all of the transport sold off as a pretty significant correction. They always sort of recover from that, and that's true in every time Amazon does something. But I want to get your take. I wrote this piece about the fact that Amazon should buy Forward Air. Do you have any thoughts on this? I know you stayed close to the Forward Air story because you had I think the Forward Air story is one of the most underappreciated stories in this sort of legal conversation, the drama that took place in the state of Tennessee and Delaware courts. Just bring our viewers up to speed on all the chaos that was the Forward Air Gate.
Yeah, I mean, ultimately, Forward Air and Omni Logistics merged after they went to the Delaware Court of Chancery, the Madison Square Garden of business litigation. And when that deal was finally consummated, both leadership teams kind of got a haircut. And new leadership came in, and they were looking at this combined entity, the incredible story of Forward Air, which is not a monopoly, but it is so deeply entrenched in the airport-to-airport business. They are phenomenal in what they do. Very few people can compete with them. Omni Logistics, private equity-backed freight forwarder with explosive growth over the last few years. That combined entity is still kind of finding its way, and that's the challenge that we see in front of them. As for Amazon, I mean, Amazon build or buy, and they can buy anything. They can probably build anything too. But building an LTL network, having to have the resources and the real estate to do that, it could certainly be a really interesting deal. And I got to say, after reading your piece, I'm kind of your same mindset. I think it makes a lot of sense for someone like Amazon Amazon that wants to play in this space. And Forward Air is different than every other LTL out there. It's not Old Dominion. It's not Pitt, Ohio. It's not FedEx Freight. It is a very specific business with what they do. And there's few that can match them.
Yeah, it's interesting. Wall Street obviously is reacting to it, or at least that's what it appears to be. Forward Air stock is up as high as 14% today. I think it's at 12% last time I looked at it as we started the show. And look, all the other transports are not rallying. And all the attention on the market is on SpaceX, obviously for rightfully so. But it is interesting that Wall Street likes this story. But I think what makes it really interesting is that Amazon has this LTL network, Matt, where they're definitely wanting to get into the LTL business. It's a hyper-competitive space. There's a lot of moat around that business. We don't see new LTL companies just pop up. Amazon has a really unique position to do something, but ultimately LTL is a real estate play. You have to have the physical real estate of cross docks. Amazon's warehouses, while they are representative in every major metro in the United States, aren't really cross docks. They're warehouses where freight originates from, not necessarily cross docks that you could see in the LTL business.
Yeah, I mean, your article does a great job of explaining, how Forward Air differs from the main LTLs that we talked about, like Estes and OD and Scion, all those. And those companies, they get density in those boxes. They get them filled up as much as they can. Whether you weigh it out or you cube it out, you get that box full, and then off you go. Whereas with Forward Air, it's about prescriptive, like consistent. We know when it's leaving and get it on the trailer before it goes. And Amazon, when they first came into the business, they ended up buying a whole bunch of equipment, a whole bunch of 53-foot dry vans, which of course I love, but they also bought a whole bunch of 28-foot pups. And I think initially they had this idea that LTL would be a part of their ongoing concern. Now those pups, they had like 2,000, maybe more. They kind of sat for a while until they figured out what to do with them. But I think as you've kind of outlined, this is the path that Amazon wants to be a resource for every shipper of every size. Whatever your problem, they want to help you solve it. And you can try to make your own LTL, go buy whatever remnants of yellow might still be there. But Forward Air is a phenomenally interesting company. We know a lot of the ownership of Forward Air today is private equity funds, among others, and they're always looking for a great way to maximize shareholder value. And if Amazon looks at this business as a going concern, no one can disrupt what Forward Air does. I mean, they are great at what they do. Amazon potentially could have some complementary and cross-sell opportunities, which again unlock a lot of revenue and makes Amazon even more impossible to separate from the global supply chain.
Yeah, it's interesting, Tom. You covered Forward Air in your days at BB&T as an analyst. It's such an unknown. In fact, I remember Donald Broughton. Speaking of Donald Broughton, when I was running temporarily, I was there for 4 months running. US Xpress had an airport-to-airport business called Dedicated Express Services that became Express Global. I was there for 4 months to basically help sell the business. That wasn't public. I caught a lot of heat, by the way. 26 years old, getting just scoured. It prepared me for being on media is the thick skin of getting just obliterated. Don Broughton wrote one of his really poignant pieces about me and how ridiculous it was for Max's son to be at 26 years old to be running this business. And he misquoted me, but we'll leave that aside, or at least took a quote out of context. Having said that, I find it interesting that Forward Air is an unknown commodity, that no one talks about it. In fact, I asked Ryan Peterson a few years ago, the CEO of Flexport, why they didn't look at Forward Air. I'm not sure he really was familiar with the business. It's sort of like the best kept secret in transportation.
Well, it is, and the bulk of their customers are freight forwarders. Now, this is where I'm a little bit rusty, but I think part of the Omni rationale was that they had more direct relationships with shippers. And Forward Air had developed some direct relationships with shippers, but they were always afraid of offending their freight forward customers. So this whole airport to airport niche that they had developed, it's been defensible. Like you said, you guys tried to get into it. Transport Corp of America also tried to do that, and I forget if it was the late 90s, early 2000s.
CRST did as well. TCAM, TCAM, Transport Corporation of America, which is now a part of, I guess Heartland ended up with.
Yes, parts of it.
Heartland ended up with TCAM. It was part of the TFI business, and CFI was part of that, and it ended up at Heartland. So TCAM tried to get into it unsuccessfully. You also had CUST got into it.
Yeah,
US
and they all exited. That's the whole thing.
You couldn't. I mean,
it was
look,
hard.
Bruce Campbell, and I know you know Bruce.
Yes.
I had a tortured relationship with Bruce Campbell. He used to get on the conference call with analysts when I was running US Xpress's business and just would call about gutter rate pricing and totally would exploit. Like, he was throwing a lot of shade. A couple of years ago, this is probably 6 or 7 years ago, I got an unsolicited email from Bruce Campbell. Now, this is a guy that tortured me as a young executive in my 20s. I carried this sort of like scars of being tortured by Bruce Campbell. And it meant more to me to get that email. I still remember it, where Bruce Campbell, who is sort of the guy who really built Forward Air into what it is. I mean, Niswonger was the founder, but basically congratulated me on FreightWaves. And I'm like, I've held all of this like resentment on how brutal this guy was. He played the Sun Tzu book. And you could not compete against Forward Air, because what Forward Air would do is anyone who entered their market, they would basically go and lower pricing. They would do substantial price concessions. They wanted to put you out of business. And one of the sort of arts of the Bruce Campbell playbook was, if you entered the market, they would go to customers and say, they're going to be out of business. In fact, this happened to us. So it was Memorial Day. The week before Memorial Day is 2004, I believe it was. I was running, or 2005. I was running Express Global, been running a couple months, and Excel was their Forward Air's second largest customer. And I sat down with the head of Excel's business, and she told me, she goes, Craig, I'm going to commit my entire business to you guys because we're the only national network. She said, and this was like 2 weeks before Memorial Day, and it gets really important, the date does. She goes, but Forward Air says you're going to be out of business by Memorial Day. Now, this is just 2 weeks before. And I said, no, her name was Susie. She probably lost her job because of what was about to happen. I said, Susie, I give you my word, there are no plans to sell the business or shut it down. Well, 2 weeks later, Andy Clark, the CFO, and Bruce Campbell got on a plane out of Greenville, Tennessee, and flew to Chattanooga, Tennessee, and made a deal, as Donald Trump likes to say, and put us out of business. That was by the way, that was on a Tuesday. Wednesday, the deal was basically negotiated. Friday, we were out of business. And I had to pull a bunch of executives together and say, look, we are shut. Like, I didn't tell them we were shutting it down. We said there was like an FBI thing because we had some freight that was stolen. It was a sting. And we sent all these executives out to 80 different terminals around the country to shut it down because we were worried about the freight getting stolen. When you're finding you're going to lose your job because we're about to lay off 600 people. We said, you're going to Boston, you're going to Dallas. But I remember how Forward Air was just so, I mean, under Bruce Campbell, it was Sun Tzu's playbook like there was no other. If you left Forward Air and you went to a competitor, you were done.
Yep.
And they would take significant rate increases if you moved your business to, in our case, Express Global. They would jack the rates significantly higher as a punishment for even thinking about not doing business with Forward Air. Absolutely, I learned so much from Bruce Campbell. I hope he's a listener to our show because I've carried the lessons of things to do when you want to protect your market. It has this amazing moat, and I think that's the part of the business, Matt, is this moat around the business. You covered the Omni drama. Arguably,
Absolutely.
Former management destroyed more shareholder value than any single company in trucking history.
The challenge for Forward Air, to your point, is they had built such a deep moat for what they did. And so to your, when they talk about strategic entry deterrence, how do I stop a new competitor from entering what I do? That's what Forward Air does. And even Walmart did that with a company called Lidl when they tried to come to the United States as a bakery. Same with Aldi. So the reality is for Forward Air, they had to find a way to grow the company. How do you grow revenue? And when you start looking at intermediaries, and as Tom mentioned, the freight forwarders were the lion's share of the business for Forward Air. They're not going to go build international relationships. They want to continue to work with someone like an Omni or some other forwarder. And when they looked at Omni, they said, this is the vector for us to grow. And I think both teams were on the same side. But as time went out, time kills all deals. Once the activist shareholders got involved, they realized they could slow the process down. That's how I started covering the story initially, which was the injunction in Tennessee, which ultimately, as I predicted, got dismissed. The case moved on. But by the point it was getting closer to our time in Delaware, Forward Air had gotten cold feet. And they said, this is what we want to do. I still think the thesis of this combined entity makes sense, but the market had shifted and the leaders who actually architected the deal were no longer in play. They were no longer there. And so you have this weird moment in time for Forward where they're still digesting this $1 billion, $2 billion deal and not quite sure what the future holds for them. So as Amazon begins to look at this market, I mean, we know Knight-Swift has been buying LTL players, so this may make sense. And they're such an aberration for LTL. But the story of Omni, the story of Forward Air, is one of the greatest examples of our industry to understand very specific legal topics like specific performance. We had seen that with Musk and Twitter when he tried to back out of it, but he was still forced to do it. And there was no off-ramp. This deal was going to happen unless both parties said we're not going to do it. So it's a fascinating case study of what these deals can do when things look great and then they fall apart.
By the way, it's funny you mentioned specific performance and you mentioned the Twitter, which is now X and XAI. I don't think there's a better deal maker than what Elon Musk did, because if you look at the SpaceX IPO, something like 85% of the TAM in that business is AI. Like, if not everyone, I think the space commercialization is a couple of trillion. It's something like $4 or $5 trillion is related to SpaceX core business, which is satellite constellations, cellular over satellite, space commercialization. The vast majority, something like $21 trillion, is actually AI.
Wow.
And this was a business that Musk really just tweeted and then had buyer's remorse when he realized how much of a disaster that business was initially. And then he merges it with his own company. Like, a remarkable deal. We're talking specific performance.
Yeah, so he had tried to back out of the deal. So when you have to try to get out of a merger that you don't want to be a part of, there's usually breakup fees. But with the Elon Musk and Twitter deal, there was no breakup fee. It was going to be done unless you had a material breach of the contract. And so Musk did actually argue there was a material breach of the contract by Twitter when it came to some personnel who were let go and all these other things. But the reality was those were not material. A material breach, and even Forward Air had said they thought there was a material breach when it came to Omni, but a material breach has to be material. Like, the example I give is if you're going to buy a house and you've signed the deal and you get in there and they ripped out all the piping, all the electronics, all of the utilities, like, now it's a different house. Like, it's not the same thing. That is a material breach of a contract. So materiality is something we got to learn about, but it's fascinating, Craig, and Tom knows this, I think, as well. The same lawyers who represented Twitter represented Omni in that merger with Forward Air. So they all knew the story. They knew what arguments to make. And even if they wanted to protract a litigation, when you know specific performance is the only remedy, that's when the court says, money doesn't solve this. The only thing that solves this is to make the thing happen. And that's what specific performance is. When the court in equity steps forward and says, this is going to happen and there are no off-ramps. So the deal that was done with Omni and Forward Air contemplated no way off. And same thing with Twitter and Elon Musk. It was contemplated, designed, and written that there was not going to be an easy off-ramp. And they did not find an off-ramp, even though they thought that they wanted one. No, that's not how that worked.
Yeah, specific performance is interesting. I remember when Knight-Swift was buying US Xpress, there was some questions about whether, the market started to really deteriorate even during that deal, and there was questions about whether or not that would happen. We talked to counsel that, like, specific performance in Delaware, it's, this is going to happen, or specific performance. It may have been Nevada, because US Xpress was a Nevada based company. But anyway, specific performance is the same analogy or same example was the Twitter Musk transaction. The Forward Air thing is interesting, Tom. I remember when I was selling against Forward Air, the whole religion was that you never sold direct to shippers. And I remember the big thing that Forward Air would do and use against US Xpress and CRST and even Town Air Freight, which was a Midwest business that they bought.
Terre
that
Haute,
had some,
I think, right? Or Fort Wayne?
They were Midwest. They sort of owned that entire sort of Ohio Valley and a lot of automotive freight. But one of the things I remember that they would use against US Xpress and Express Global was that we had direct customer relationships. And their whole statement to the forwarders was, we're going to protect you because we only provide freight services through forwarders. We're essentially a wholesale product. We will never, this was sort of the statement, we will never go direct shipper. Buying Omni completely blew that up. Now Forward Air had that had bought an intermodal business, had some container freight stations. The CFS business probably fits really well synergistically with their international air freight. Intermodal was a little of a weird one as well. I think a lot of it was sort of dray to port dray operations, but you could argue that maybe there's some international components. But the Omni deal, talk about the most shareholder deterioration of any single deal in history.
Well, I remember the day that deal was announced. I think it was in May of 23, so just over 3 years ago. I didn't know much about Omni. I knew the name, but I've been off of Wall Street now for several years. But the first thing I thought was, why are you buying something this early in a downturn where you don't know where basically the freight forwarder revenues are going? Now, Matthew and I talked about this one time. There may have been really good business reasons to do it, but for me, I was struck by the timing because we were in a period where, ocean forwarding revenues were going to be declining for at least another year. So you didn't really know what you were buying in terms of the financial performance of the company. You may have known other good reasons, customers, international growth, and then I saw the amount of leverage, and I told my boss, Chad Eichelberger, some of the audience will know him, this stock, which was around $110 that day, I said, I think this is going to be 60 or less within 2 days. And that's about what happened. And
You're not wrong. I mean, it's
eventually went down to $12, then had a rally in parts of 24 and 25 that took it briefly back to 40.
There was conversation. There was a process that the Forward Air management teased that they were going to sell the company. Private equity. There's a couple of firms that were looking at it.
Yep.
Didn't consummate those transactions. I think management has talked about that I believe the statement is that they did it, and then they lost their largest client, which is reported to be NVIDIA, which was Omni's largest client, which is basically $100 million plus business that really, and that took the stock from I think 20 something down to $10.
Yes.
And there's a lot of questions about just Forward Air's as a entity really being able to sort of thrive as a standalone company. That was really the point of my piece. Tom, I got to get your take on Amazon's entrance into LTL, because that's what this is all about. I mean, the Forward Air story is interesting because there's just so much drama. Matt was one of the few people covering it, and I'm probably one of the few people in freight media that even knows what Forward Air does, having competed against it, because it's such an unknown. People are like, it's not really a traditional LTL company. It's got this weird scheduled network. It just feels like a real ripe opportunity for what Amazon wants to build. But I'd love to get your take on Amazon LTL entrance.
Well, I think a lot of the early things that I've read about it's going to be more like a broker. We've talked about, of course, they don't have a traditional terminal network, with break bulk facilities. I don't know enough about Amazon, but I think, as you've said, it's more of a traditional warehouse. Freight goes in, it gets put back out, but it's not a cross-dock facility. So I think a lot of their early success will be more attacking brokers that have a sizable LTL presence. And then it will remain to be seen what they do from an asset perspective over the next 4 to 5 years.
Yeah, pretty amazing. Matt, any take on the Amazon LTL story?
I mean, it's just fascinating to see what Amazon gets into. They come in, they say, let's dabble in this. Do we like it? Do we love it? And by the time they're a little bit in there, they think, I could do it better than these people can. And they come in and lo and behold, they're able to do it. So time will tell. I mean, I don't think Amazon wants to be Old Dominion or Saia, but to think about what they could do with that offering, I think it's going to be really interesting, especially to think about reverse logistics. I buy a lot of stuff from Amazon, and I also send a lot of stuff back, and I take those trips to UPS probably once a week. So if it makes the return process easier or gets me appliances quicker, I'm all in that.
My wife taught me something. I didn't even know this was a thing, but apparently you can go to Whole Foods and do returns.
Yes, you can.
Whole Foods, which was, I think, pretty interesting.
Yeah, I did know that, and I think also Kohl's for a while.
Yeah, Kohl's had a return business as well.
I don't know if they still do, but I would often see people go in there and then walk right back out of the store. So I don't think it drove
Maybe that wasn't great for Kohl's. I think Kohl's had struggled as a retailer.
Correct.
Sort of in this lower cost, no man's land where you're not the cheapest, you don't have the greatest selection, and you got discounters like TJ Maxx.
Well, they were sort of a better version of JCPenney.
Yeah, for sure. But it's still around, right? Isn't Cold Start around?
They still are.
Yeah. So look, you survived long enough to sort of see another day.
That's right.
Matt, I got to ask, the whole insurance conversation with Montgomery has been something that we've talked about earlier. Any updates on what you're hearing in terms of regulatory developments? Tom mentioned they had met with the FMCSA and DOT about some of the changes. I don't know if you caught that part of the segment about the different types of rulemaking that they will do, tightening the self-certification standards. What are you hearing?
Yeah, so, I think the FMCSA has a lot of industry folks coming and offering suggestions. TIA has been out there trying to say, here's what we want to see happen. We see TIA making a call on FMCSA saying, please disclose the list of dangerous carriers. But there's still a lot of uncertainty here. These cases are going to move forward whether the FMCSA does anything or not. And what your vetting process becomes is something that will be discoverable in any litigation you're involved with. For brokers, if you don't carry the liability insurance that can cover this kind of contingent auto or general liability, you're in for a very rude awakening. The government may not mandate this for you yet, but you're going to have it to keep your business solvent as cases continue to percolate. I would say that the story for me remains, if we want to make the road safer, you have to increase the minimum liability insurance for motor carriers, and you have to give the FMCSA more resources. If you don't do those things, then all we're doing is just shuffling things around. Maybe MODIS helps, probably not significantly, but we know that brokers are looking to our government to give them some guidance as to what they're supposed to do, and we're still really, really far away from that.
Thoughts on increasing insurance rates? You work for an insurance agency. I imagine that would be a good thing for business.
No, not necessarily. A lot of times when there's a mandate, you always think that it's going to be a huge windfall for someone. So, for example, if electric vehicles were mandated for consumers, then it's pretty obvious to identify that the electric car makers and the dealerships are going to make a ton of money. But what you've got in the insurance industry, you've got underwriters, and let's just say, the ones focused on the $1 million minimum. Technically it's $750,000, but I'm not aware of anybody buying $750,000. They're wondering if they've lost their sanity being in this business at $1 million. So if you were to double it to $2 million, they're like, it doesn't become more attractive to them because they're losing money on the auto liability already. So a lot of the discussions that we've had and many others have been, this is why you've got to improve the risk profile of the industry so that it is a tenable investment for these underwriters. And so that's why all of these things that we've talked about, from ELD reforms, CDL reforms, making the road safer, then you'll find underwriters more willing. Now, as an agency, yes, it would be a good thing for us, but for the underwriters, we don't want to see the number of underwriters that we work with, which is about 200, we don't want to see that drop to 150 because 50 leave the market, being unthrilled at having to take on more risk that's not been regulated around the edges, if that makes sense.
The volume certainly goes down, and I think the argument, and I know the topics that I'm going to get a lot of hate mail on. One of them is higher insurance rates. Drivers, owner-operators absolutely get fired up. But I think the data is pretty clear. If you look, Matt, you've argued this, is 1985 is the last time we had the rule put in place as to what a motor carrier must carry in a minimum insurance, $750,000. Just inflation, and I'm talking about just standard CPI inflation, takes that to almost $2 million. And if you add healthcare inflation, you're up to like $3.5 million.
Yeah. This one, when April Fool's Day came around, I took an actual part of the quadrennial report the FMCSA puts out on insurance and said, this is where the insurance rates are going to go. Because the FMCSA for decades has been saying, hey, we are underinsured for the risk that we create. Now, there's a question of if you have higher policy limits, the lawyers are going to ask for more money. The lawyers will always ask for more money. That's just what we do. But what you're seeing happen now is brokers and shippers are putting higher requirements for their partners. And so C.H. Robinson very recently has announced, hey, we're going to be increasing our requirements for insurance for motor carriers because they realize if it's a higher barrier to meet, you will have capacity that has to exit. And that that presumably means if you have adequate insurance, you're probably a better motor carrier for them to select. And so maybe the market corrects this themselves and doesn't just say, wait for the government to do something they should have done 40 years ago, which is to adjust that minimum to inflation. And then that would give us a better understanding of what it should cost to move things across this country.
Now, Matt, I know you have been traveling this week on the road, long road trips.
That's right.
Weather in Chicago, I imagine, has disrupted some of that as well. The TCA, the Truckload Carriers Association, we had the president on earlier this week to FreightWaves Today. They published a piece. It was, I think, a 50-plus page proposal that they really want some changes to the industry. One of the interesting things that came about it as we interviewed them, Julie and Malcolm did, was the idea I thought was incredibly encouraging, was the TCA admitted, and I'm not saying they hadn't admitted this before, but they were very proactive about the level of fatalities and accidents that happen in trucking. I thought it was interesting because this is an association, and typically, at least the ATA has been somewhat dismissive, or I shouldn't say dismissive, defensive maybe, about how safe the industry is. I thought it was interesting that the TCA actually came out and was sort of doubling down on some of the safety records of our industry. Matt, did you catch this at all?
No, I mean, I was unfortunately on the road for about 14 hours yesterday, only driving for 11. I kept my hours of service as clean as I could. But no, it's what's happening is it's a reckoning. It's a reckoning for our industry. We have been telling everyone for a very long time at the high schools and the colleges, if you get into transportation, you've failed. We say the industry needs more drivers and the industry is safe, but ultimately it's the 8th most dangerous job in the United States, and we have woefully underfunded our regulators, and so we must modernize. We must take into account the years of just neglecting our industry. And that goes back to things like vehicle maintenance. And that's why deals around maintenance and repair are so interesting, because now we realize you can maintain your equipment safely. You just have to be willing to go in a preventative sort of way.
Yeah, this was the recommendations. Let's keep that on screen for a second. Substantial increases in FMCSA safety staffing. They are wholly understaffed. Matt, you and I have argued that the FMCSA needs more money. They need more resources.
We've been screaming that from the beginning, Craig. You're absolutely right.
We are still going to go in front of Congress at some point. Hopefully we'll get the invite to go in front. Maybe the three of us. Tom, I hope you'll join us as sort of expert witnesses on this business. But they also talked about really the registration modus. Oh my gosh. Can we talk about modus in a way that is not like, are we allowed to say how bad that rollout has been, Matt?
I would say that we could say it's been less than ideal. I mean, the reality is we need change, and change requires a lot of things to happen, oftentimes not positive things. If there's any consolation as we look at modus is that the government is trying to do something. They, again, need more resources and more expertise. So this has been a painful process for a lot of motor carriers and brokers. And maybe this will be the thing that kills capacity, because people just don't want to go through all the rigmarole of a new portal.
I mean, Tom made an interesting point that I hadn't thought about, was there have been some registrations that have come up, maybe an increase in registrations. One of his comments, and I don't know if you caught it, is that he believes that motor carriers, these bad actors, are just stacking operating authorities because they're assuming that things are going to get harder and harder going forward.
Yeah, if it's $300 to $350 to get a DOT number, that could end up somewhere between $5,000 and $10,000 in the future just to get one. I think they're going to be looking at things on the front end a lot more. The whole entry level for a fleet, some sort of an entry level safety audit will be done potentially. That's supposed to be done, Matt, within 12 to 18 months, I think.
Yeah, ideally it would be 12 to 18 months, but whether they have the resources to do that.
They really haven't had the resources to do that. So I think there's going to be something done on the front end as well. And so just stockpiling. That's a theory of mine, that they're stockpiling these DOT numbers, anticipating a more difficult day.
It's interesting, the theories that we have, oftentimes they sort of feel fringy. It's sort of like the UAP stuff, and then all of a sudden the crazy stuff that you're like, there's no way this is real, actually turns out to be true. I mean, non-domiciled CDLs, there were conversations on X for a year, certainly. I was getting some hate mail from the America's Trucker United about the fact that we weren't covering this story. I initially dismissed it as like, this couldn't be real. This couldn't be true. I felt the same thing about the entry-level driver training program, how ridiculous that rule is. The fact that you can self-certify, you watch a YouTube video and boom, you're well on your way. You talked about the fact that there's no mandatory driving requirement in terms of hours. Training requirement. That's ridiculous. As a pilot, I have to have 40 hours of time in an airplane.
I think when people realize what the regulations actually require, you go, wait, that's why we have a 22% national out of service rate for commercial vehicles on maintenance and repair. I mean, crash indicators, we talked in other episodes, that doesn't really tell you who's at fault. So understanding the fault of the trucking company versus whether they were involved in a crash or not. But the more our country looks at what is happening in our business, I think the desire to do something different is increasing. I mean, Gordon McGill was just on Tucker Carlson talking about some of the same issues we've been talking about, and he was a victim of cargo theft. His ALP or ALP stuff got stolen. It was something like $7 million load. So all of these things are kind of coming together, and the national attention is into our industry, which is what gets me excited when we think about things like maintenance and repair, because that is something that every motor carrier can control. You cannot control the cost of fuel. You can't control the cost of a lot of things, but you can certainly control how well you maintain your trucks and trailers.
I want to bring back the TCA's proposal back on screen because there's a couple of other things that are there. By the way, if you hear the background noise, that is rain. Matt, you're not the only one. You don't have a monopoly on rain in Chicago. We have it down here. I have a Jaguar convertible that I bought during COVID. It's my little toy. Wrong day to be driving a convertible. I'm not going to be driving that thing around today. But they also talked about modernization of safety fitness determination process. It's interesting. We talked about the ELDT provider really changing the fact that there needs to be better oversight in CDLs. Improve crash causation analysis and data integrity. A lot of questions. I mean, I think Modus's goal is to fix a lot of the problems with the registration process, a lot of the issues around registration process. And look, I think as even the FMCSA has said, give it time, it will come around. It does remind me of healthcare.org. They eventually got it right?
Sort of. Let me just give you an example of a suggestion that we made. So in terms of CDL oversight, one of the suggestions, and again, we don't know what's going to be accepted. They're on a big listening tour formulating some potential notice of proposed rulemaking, but is that the states need to be audited on a regular basis for the CDLs that they issue, whether that's every other year, which means you do 25 states a year, or if it's every third year, you do 16 to 17. They're not used to that kind of accountability because you can do it once, we go through this, but what's going to be the sustainability? And let me go back to ELDs for a minute, Craig. If we only had one reform that were to be made, aside from Modus, I would say that's the single biggest thing is to get approval of third-party companies who are going to approve these ELDs, because that's the single biggest incentive to cheat. When you've got ELDs that can be manipulated from Armenia and Serbia and Croatia and numerous other places, well, if suddenly that cannot be changed, where you're running 160 to 180,000 miles per truck on a solo operation, all of a sudden everything else comes into play. So fix the ELD. Of course, we want to fix all these other things too, but that's the biggest profit motivator for these fraudsters.
Yeah, Matt, final word on that?
I mean, we got to get rid of self-certification. Now, whether you go to a platform of third parties that do that like they do in Canada, and Tom alluded to, or you have the government itself step in and actually look at the technology and validate it meets its threshold. Self-certification is a terrible idea in nearly every aspect that I've ever thought about. I mean, self-certifying truck driver training schools, self-certifying ELDs. There's over 400 or so ELDs that have been revoked so far since the mandate even came into place. So yeah, I'm all for getting rid of self-certification. And I know Administrator Bars and his team are also adamant against getting rid of self-certification.
Matt, your microphone's breaking up. I don't know if it's our thing, but it's getting muffled. Again, the weather here is a little crazy. Not like you guys have in Chicago. I mean, crazy tornadoes. I tried to get from Aspen, Colorado to Chattanooga, Tennessee. I had to go through Atlanta and then take an Uber from Atlanta to Chattanooga last night at midnight.
Oh, man.
But I got to tell you, I got to tune into Freight Expectations. I got to tune into FreightWaves Today. And I thought the team did a great job when I was out.
The weather is great, Craig. I brought it with me.
You did. So coming up on Monday, we have Brad Jacobs is going to be our guest. He is the chairman and CEO of QXO. RXO, by the way, is a Brad Jacobs founded company. And so we had Drew earlier today. You can hear more about the person that put all of that together, as well as his next venture. Brad Jacobs has written 2 books about how to make a few $1 billion. He's going to teach us that on the show. Can't wait for that on Monday. Again, if you have missed any of these shows, are on demand. Any of the segments are on demand. You can tune in. Go to FreightWaves.com to see all of the segments. We're posting all of those videos. Be a part of our experience here at FreightWaves Today. We want to thank everybody. You can find Matt Leffler on Reddit, where he lives. You can find me on X, and you can find Tom in email. LinkedIn, I think, also as well.
Yes.
Appreciate it, and have a great weekend.